range that you're in, basically 3.3% range. This is actually how you get your ranges throughout the day. So just go here, go to the daily time frame here, and what kind of happened. So where's your daily range here? This is how you can kind of get your ranges, kind of get your levels. So right now on the NASDAQ, we closed the day on QQQ down about 1.9%. Gonna draw a fib here on this daily level here. I want to make sure if I'm going to go long, I definitely want to get above the 715.33 level. Obviously, it's easier said than done. How do you even get involved there? But again, the first step is identifying what we did here. Here's level 1 here, level 2 here. Going to mark this fib here. There's a bunch of different ways you can mark fibs, just running you through a crash course of how you do it. Second level here on the previous day that I want to get back above would be right here. Hold on. Right here. Third candle would be down here, not irrelevant. So I have 2 levels here that I marked, and then this one I marked is overall top to bottom kind of here. You kind of see this is a zone you're in here, so you can kind of see right here when you're getting involved in the market, you don't really need to get in, like right here is kind of the war zone. So right here is war, war, war. Obviously we can find different things here, but hold on, I gotta answer this. It's the pharmacy. So right here, you kind of have your war zone here. So you don't have to get involved in this, let it sort out. But what I'm looking for on the 14-day time frame is kind of something like this. So I'll back up right here. So looking for a bullish engulfing candle here on the 14-day time frame here. So right here we have this right here. None of this is done. What I'm looking for is kind of something like this here. Obviously, this is just technically speaking. I'm not even getting super technical, just trying to walk you through just a bit of my thought process without giving you the full-on answer. So right here, we're going to delete this chart here, and then we're going to go to the 14-day time frame here. So right now we have a doji right here, right, like we mentioned. So we have a doji here on QQQ. So right here we have this right here, and looking to complete a bullish engulfing candle up here, right? So again, on the 14-day time frame, where's kind of our middle ground? Where do I want to like not break down below? I can tell you exactly where, in my opinion at least. I want to be at, I guess I got that. I'm gonna have to look at that again because this is different. But anyways, okay, so I did a different candle. Okay, so right here, definitely want to close above and get back to 716. Gonna walk down through my levels on the NASDAQ here. So on the 14-day here, let's go down to the shorter time frame, like 2-hour time frame here. So here's this other candle here. Here's this candle here. Levels that matter to me. And then here's a 4th candle here. This already might be done though. Yeah, kind of right here at 716. And then we have this candle right here. Looks like a golden pocket, honestly. Let me see if price is kind of in this area where it kind of rejects or kind of rips. Yep, right here. So you can kind of see, didn't see the left of it, right? Now you can kind of see right here. We identified a very hot fucking spot here to get involved in. Well, a few. So do I want to get involved in a chart? Again, we can mark lower levels. I'm not going to debate that. But what my point is right here is, right here you can kind of see like A+ setups, right, where you can pivot long or short. A lot of people don't understand that. A lot of people, right, again, I can mark stuff up here, but people, instead of entering it in a pivot that's like 50-50, they're into a pivot that's like kind of 70-20. So like something's just already tilted against them. The market's already tilted. I don't need to fucking make it even more difficult. So right here, again, you can kind of see these are good, really good zones to kind of get involved with here. And I'm not going to do them all. You can kind of see them here. Like right here, good zone, 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 and same here. You can kind of see literally where you drop and rip. Nobody knows that, right? So it's about adapting, but if you don't have levels marked out, if you don't know how to mark them, you're fucked. Good luck. I just showed you how to do it. So anyways, you have a pivot here. Obviously, we do have a morning star right here on a time frame. I'll show you what a morning star looks like. Morning star looks like this. So you have this Morningstar reversal right here. So you have this. Obviously, it's pretty textbook. If you break right here, again, keep in mind this is a 2 hour time frame. Every time frame is different. You break here. Obviously, this is not a Morningstar here. What I need to have this continue to be a Morningstar is I need a bullish engulfing candle. A bullish engulfing candle obviously looks like right here on the picture. But what that looks like on a chart is like something like this that engulfs this candle. That's why it's engulfing. You take out this candle, big green candle, right? So those are my levels here for QQQ. Looking here at SPX here levels that I have for tomorrow. So right now you have an evening star on the daily here. You have an evening star on SPX here. So I'll show you what evening star looks like. Evening star reversal. Evening star reversal looks like this. So you have an evening star here on the daily, which is pretty king here. Gonna take off these indicators because they're not helpful. Key levels.
There's your dip. Jesus.
You had a dip?
Oh, on my chart it was a big dip.
Oh shit.
50-point candle, man.
I love that, baby. Good. Give us a discount. So I didn't go long. That's why it's good to kind of wait for whatever. But right here you have an evening star here. Right. You have an evening star here on the daily. You have an evening star here on the daily time frame for SPX. Once we crack 70, I tell people generally I don't like to go long. There's a reason for that. We can get into that into like another technical video here. But right now, I mean, you have a textbook evening star here, a bearish pattern. Usually evening stars are formed by this. So right here, look at this chart right here. This is an evening star in formation. Evening stars come in all different shapes and sizes, but usually it's fall through with engulfing candles. So here's the start of an evening star right here. It doesn't look like one, but it is one. And you have this candle down here. Here's a pivot. That's like a right shoulder within a head and shoulders. If you were to go down to micro time frames, this would be a right shoulder. You can kind of see those right shoulders. I kind of view right shoulders as like these kind of like pivots up here. So that's a pivot, right? Right here is a pivot here. So multiple head and shoulders here. And obviously you do have like a pendant here on the daily time frame. You can call, you have a wedge, you have a whole bunch of things, but anyways, until we kind of flip and break this on a daily time frame here, I mean it's an evening star. What do evening stars do, right? You're followed up by what? Bearish engulfing candles and etc. 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 So you know, how are we going to get our levels here? Let's clean it off here again. I'm not going to mark the daily. I'm just going to mark the high to the low here. Where are we at here? So SPX looks like, as long as it's above on a daily time frame perspective for this entire range, in my opinion at least, as long as we're above 7470 bullish here. From an EMA perspective, I do look at and view the EMA, 55 EMA as institutional here. So I'm going to throw it and stop that on here. Curious to see if we're above or below that EMA line here. So we're going to see here in a second. Where's the EMA here? So quite a bit above it here. So I have my time frames there. Let me just mark these levels out here. These are how you get laser levels. Here you go. Here you go. Here you go. And you'll notice all these levels.
Don't forget to change your batteries.
Shit, and change my bitch, right? I need 2 of them. Rough. So right here, looking at price here. So here's my levels for SPX here. Levels that are most likely to be hit here. I do want to at least do, I said I wouldn't, but again, I don't know, I'm high, so I'm changing my mind again. So right here, what I'm going to do here is I'm going to mark this chart here. Something that I want to get back above on a daily time frame is this level right here, 7542. The way I kind of view this 50% line here, which is that red line mark right there, is again, if we own a company and we have 50-50 split here, if you go down here, right, somebody's going to be in the lead. Somebody's going to be up. So if you have ownership more of this company than me, who's in control? If you're a bear, bearishly speaking, you're in control. If I'm a bull, if I'm above it, bullishly speaking, right, we're bullish. That's it. People overcomplicate that so much and they shouldn't. So don't. So that's SPX here. Those are my kind of levels here to watch. Levels I really want to watch here for ending the week, or kind of weekly levels, or big key levels are right here. Oh, big key levels for me are kind of right here. to right here. Upper level right here that we can break is right here. So your range is different from QQQ, obviously, because like it's obviously smaller. But my range right here for the week is 7562 to 7470. Again, tomorrow we might just rip up. We honestly, straight up, we could break all-time highs. We're only 100 points away from an all-time high. That's what people don't get. That's like a 2% day. You know what I mean? So we got PPI tomorrow, right? And we got some bank earnings tomorrow. If banks are bullish, I'm not saying that banks are going to cause the market to rip up, but damn. I don't see how they don't. We have all these peace deals, all these different negotiations going on. Nothing's happening. It's a circular jerk situation to where, you know, everyone's just saying it's a he said, she said. So here's kind of a report for tomorrow on my Substack. You guys can subscribe for free. We have 5 banks, one morning CPI print, writing tomorrow in shotgun. These are the last prints here for the earnings. Banking earnings, the last 8 moves, JPM, right? So you can read this on Substack. I'm not going to go through it. But right here, you kind of see the last moves and the implied moves here of, you know, what can happen. Obviously, when we go down here throughout the...
Welcome to this video on Operation Margin Call. We are exploring the recent technical market shifts, starting with how Seoul has broken its neckline and the resulting pressure on DRAM. Let's look at what the banks are deciding regarding the $135 level. This video breaks down what the index was hiding. While the S&P might have looked stable, the reality under the surface involved a chain reaction triggered by developments in South Korea. We examine how institutional positioning precedes retail reactions. The tape reveals 2 stories from the same session. While the S&P remained flat, the NASDAQ saw a significant gap down linked to DRAM pricing. We examine whether this is a cliff edge event or a continuation of a previously identified technical break. The trigger for the recent gap down was an analyst note regarding SK Hynix earnings. This video analyzes why the US ADR opened lower than its overseas counterpart and why the IPO price is a critical level to watch. Exhibit A shows the gap into the IPO print. We highlight that the main damage occurred during the US session. It is important to monitor for signs of a potential washout versus an orderly decline as margin calls in Korea unfold. The overnight mechanics are crucial. When US sessions mark positions lower, the subsequent opening in Seoul can trigger a loop of margin calls and forced selling. This video examines the signs of a potential market capitulation. We are looking at the cascade of margin calls in Seoul. With many retail positions currently underwater, forced selling is accelerating technical breaks. We will analyze how to interpret absorption versus sustained weakness. As new levered ETFs start trading, the volatility landscape is shifting. Because many of these products are not yet liquid enough for standard hedging, dealers are forced into mechanical selling, which further amplifies market moves. This chart illustrates the growth of the levered ETF factory. The increased use of these vehicles for calls and puts, rather than the underlying stock, creates asymmetric hedging challenges that distort market volatility. Why do some products become difficult to hedge? We follow the sequence from IPO to index inclusion, showing how retail often becomes the exit liquidity. Our focus remains on understanding the mechanics and marking the levels. Part 1 of our analysis focuses on the patterns emerging in South Korean markets. The head and shoulders pattern has broken, and we must deal with the implications of that move. A head and shoulders pattern is often a map of distribution. By analyzing the left shoulder, head, and right shoulder, we identify how institutions transition inventory to latecomers and why a neckline break is so significant. Looking at the EWY, we see how the index struggled under the 55-day EMA before finally breaking the neckline. We emphasize the importance of trading what is actually happening rather than relying on previous forecasts. When projecting targets, using percentages is more accurate than using point values. Since price levels change, percentages help maintain consistent relative distance. We identify the target zone based on the neckline break. This final slide shows the projected target zone for our analysis. By measuring the distance between the head and the neckline, we have established a probability area where we look for market reactions. Moving to the Confluence grid. This is where market frameworks converge. We are monitoring key levels like the 100-day, structure shelves, and measured targets, as these are where critical fights over supply and demand typically occur. Let's look at the anchored VWAP from the March 31st swing low. When price drops below this line, it signals that the average buyer since that date is now losing money, creating overhead supply as they look to exit. Welcome to Part 2, the Institutional Toolkit. Here, we define the specific technical lines that desks use to frame their risk, specifically the 55 EMA, anchored VWAP, and the 50% retracement line. Why is the 55-period EMA so significant? It tracks the average price over a fiscal quarter. When a position trades below this line, institutional risk desks begin to question their exposure, leading to real order flow adjustments. This chart shows the 55 in action. You can see how multiple touches defend the line until the mandate changes. A clean close under this level serves as a primary regime warning, not just random market noise. We use a ribbon of 3 EMAs, the 12, 22, and 55. Each acts as a different clock. The 12 is for momentum, the 22 for swing structure, and the 55 represents the quarterly institutional stance. VWAP, or volume weighted average price, is the most honest indicator of where money has actually been deployed. It shows not just where price was, but at what level the majority of volume was transacted. The 50% rule is simple accounting. By retracing from a major move high to low, we can determine if the market is net long or net short. Holding above 50% indicates that buyers are still in control. In this example, we see a healthy trend where price holds above the anchored VWAP and the 50% line. This demonstrates that dips are being defended and the market remains in a net buyer state. Conversely, this chart illustrates a quote pickle scenario. Here, we see price below the VWAP, the 50% line, and the 55 EMA. In this state, the institutions have stopped defending, and every bounce is likely an exit. Before initiating any trade, run the triple frame check. Where is price relative to the anchored VWAP, the 50% line, and the 55 EMA? These 30 seconds of discipline help override your personal opinions. Welcome to Part 3, the Correlation Web. Here, we track how news and technical breaks in one sector, like Korean DRAM, flow through to companies like Micron, SanDisk, and the broader semiconductor index. This slide maps the transmission chain of a market move, from the EWY ETF and DRAM pricing, down through SK Hynix, US-based memory stocks, and finally the SOXX index. These are 5 dominoes linked by a single thread. Looking at the SOXX, a head and shoulders pattern is emerging. We see price action closing under the 55 EMA. While not confirmed, this technical setup requires careful monitoring to see if it leads to further downside. Finally, we monitor ASML and Taiwan Semi. These 2 earnings reports are the ultimate judges. They will determine if the current DRAM issues are an isolated cycle event or the beginning of a broader semiconductor sector decline. Welcome to Part 4, the Options Casino. Here, we analyze how the volatility market has been reconstructed. Modern products now exist that retail investors cannot effectively hedge, creating a new environment for market mechanics. Single-name options are currently at extreme levels. This chart shows the spread between individual stock implied volatility and index volatility. This environment is highly favorable for option sellers, as spreads tend to mean revert quite violently. We monitor the COR1M as the institutional panic gauge. When the index drops, it signifies heavier weightings into individual names. Rips in this gauge indicate broad exposure buying, which often marks a bottom. Looking ahead, we watch the correlation index closely. If it continues to rise through CPI, it suggests institutions are seeking index exposure. If it rolls back, the recent market bounce may just be single-name froth. Welcome to Part 5, the Macro Trap. CPI is critical, but the real focal point for market stability is the Japanese yen. We analyze why this currency remains the primary tripwire for equities. The USD-JPY pair shows a recurring pattern during negative 0.1 CPI prints. Past data indicates that when this carry trade breaks, it drags equities down with it. The current setup rhymes closely with those historical events. For our CPI playbook, watch the 10-year yield first. Bonds often reveal the truth about the print before equities react. If the yen carry trade begins to unwind, it signals a positioning shift that ignores standard support levels. Market crises rarely repeat exactly like the last one, as the crowd is usually hedged for that scenario. Today's risks involve yen carry and levered wrappers that most are not pricing. We prepare by marking levels and maintaining discipline. Welcome to Part 6, the IPO game. We focus on SPCX and the significance of the $135 price level. We examine whether the supporting banks still have the conviction to defend this syndicate price. The $135 level is critical because that is where the IPO syndicate's reputation lies. With distribution largely complete, we monitor whether defense remains at this level or if the banks are stepping aside. In the past, banks defended IPO pricing with upgrades and buy programs. Today we must ask if that capital deployment continues. We monitor the leveraged short wrapper, SPCG, as a secondary indicator for sector strength. In our desk trades, we focus on put walls. In the case of Micron, we observed it holding its wall, while the NASDAQ hit new lows, signaling relative strength. Our plan was to exit immediately if the support failed. When a put wall like SanDisk's shifts lower, we adjust accordingly. By waiting for end-of-day setups and selling weekly puts, we capitalize on high volatility. It is essential to treat these sharp moves with caution. Zooming out, recent market volatility is largely within a standard average true range. While observers scream about a crisis, the tape suggests a period of consolidation. We maintain our core levels and avoid unnecessary heroics. For our final plan, monitor the Seoul session washout, track the 10-year yield during CPI, and observe the $135 defense on SPCX. Maintain small size and stay disciplined as these events unfold.